If you're holding a large position in a concentrated stock, you already know the dilemma. Selling can mean triggering a huge capital gains tax bill, but holding means your net worth stays tied to one company, which could be impacted by one earnings report or one bad quarter. Historically, the primary way to solve that problem was to pay the taxes and move on, or to access an exchange fund through a traditional provider with high minimums, high fees, and a process that could feel antiquated. Cash exchange funds are designed to solve that. Let me show you how it works. First, you contribute your appreciated stock to the exchange fund. This isn't a sale. Under Section 721 of the tax code, your contribution is not considered a taxable event when you meet the requirements, so no capital gains are triggered. Your shares enter the fund alongside contributions from other investors, each bringing their own stock positions. Those stocks are pooled together in a single portfolio, benchmarked to a major index like the S&P 500 or the NASDAQ 100. So instead of holding one stock, you now own an interest in a fund aligned with the performance of an index. Overnight, you go from one stock to a diversified fund. Here's something that gets overlooked in conversations around tax deferral. When you sell a concentrated position and pay the taxes, you're not just writing a check. You're permanently removing that capital from your portfolio. Tax deferral is usually framed as kicking the can down the road, but the most important part is what happens while you wait. With an exchange fund, your full pre-tax capital is compounding from day one, instead of a smaller post-tax amount. So let's talk about what happens inside the fund during that time. Our flagship funds use index sync, a feature available to qualified purchasers, typically investors with at least $5 million of investable assets. Index sync is designed to keep the portfolio closely aligned with its benchmarks over time, using a combination of new contributions, distributions, and where eligible, an in-kind contribution of securities to an ETF. After the required 7-year holding period, you'll be eligible for a qualified redemption. You can receive a diversified basket of individual stocks and ETFs carrying forward your original cost basis. You can also stay invested beyond the 7-year anniversary, and your annual management fee drops to 0.25%. When you're ready to redeem, you control the timing of any future sales and the taxes that come with them. And there's one more detail worth knowing. Under current tax law, if you hold your fund shares as part of your estate, your heirs may receive a stepped-up cost basis. That could potentially eliminate the deferred tax liability entirely. The minimum investment is $100,000, a fraction of what legacy providers typically require. Everyone's situation is different, so it's worth a conversation with your tax and financial advisors before deciding if an exchange fund is right for you.